Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. I'm going to jump right in. We're going to keep this as short and sweet as we can, and here we go. Lots going on, and a lot of confusion out there on exactly why things are happening the way they're happening. But um, you know, just some quick bullet points. Home builder confidence rises for second straight month. New construction slowed in September. Retail sales beat estimates. Jobless claims suggest weaker labor sector. These are all key points. So the builder confidence overall is strong, but the permits, we can see here it actually their confidence in current sales projections, future buyer traffic, all that's going up. So they have a really positive outlook. And this is super important because the builders obviously are the ones that get us our new inventory. So when everybody talks about, prices going up as they have been and pressure on pricing going up, this is what, really is going to hopefully eventually get us the properties we need to get people into homes and also eventually with enough inventory, which new inventory is really new builder product, that new inventory, getting us enough of that supply so that prices don't continue to go up, quite as fast as they have, and people can, find more affordable housing. So, no, we want property values to go up, but not quite as fast as they've gone up over the last 3 or 4 years, right? In some months that we had there, if we remember that crazy market. So their confidence is good, but the one issue is the starts is down. And they're not, we always say this as a funny, but they're not the March of Dimes, and they're having to pay down these interest rates. And until we really see interest rates stay, we always have this up and down volatility, which we'll get into here in a minute with the 10-year treasury, which affects the mortgage rates. Um, and until that gets settled out, we can't just have this 2 weeks of low rates or 1 month of low rates and then it bounces back up. We need to have consistent low rates, for 12, 18 months, or a longer period of time where they could really ramp things up, not overbuild, but build enough to keep things moving along. And it's really to the point where, the Fed just really needs to get real with themselves and everybody else, and just come right out and say, look, we're not big on housing. We're going to be doing, much for the housing game, or they are. So we have to really come to terms with, who it is we're dealing with here. They've got a very neutral stance on this up until this point, a very, strong stance on where they're coming from up to this point. Now, anything could change, I guess, but they've been slow and old in the beginning of the inflation fight and now at the end of this, inflation cycle. So we'll see what they end up doing. We're probably going to see another quarter percent drop from them, but really it doesn't matter because they could do six more, 25 basis point drops. And that would get us to basically neutral with what's already baked into the bond market, where we were just a couple of weeks ago down to that 6%. So that's all that's really going to do is put us back to that point with six more 25 basis points drops. Unless they really speed that thing up, the way they sped it up, the way they, were raising it back when they finally started raising the rates to play catch up. That's kind of where we're at there. So the sentiment's good, but the new permit starts are slow. Retail sales, we want to track that because of GDP. That's another part of this for inflation. And that is actually up. Okay. So that's good for overall economy. Now, as far as jobs claims, though, if you really dig into the numbers, and just like every single jobs report, we had one a couple months ago. Remember when they revised it, like 800 and what was it, 818,000 jobs difference than what it really was, as far as the jobless, the jobs gains and the unemployment was shifted a bit, and we had, people wondering what in the heck happened here. Well, we're going to see that again. We're going to have another, let's see, let's jump ahead to the schedule here. Unemployment situation. We're going to take a look at this again in November 1st and December 6th. So those are the two dates to kind of watch there because once we get above that 4.3% unemployment number, again, not rooting for people to lose their jobs, but I think we're going to see a revision over the next couple of months. And just like we did with before with those jobs numbers, just like we just had a revision, all kinds of government revisions come all the time. We just had one for the FBI and the crime stats are up actually higher than people thought. So I mean these things get revised all the time. If you get into the numbers, it certainly suggests a much weaker labor sector than what was reported over the last week or two. So, anyways, we'll keep an eye out for that. But that's going to be the key to getting lower mortgage rates and kicking the bond market back down on that 10-year treasury. So, what's going on the street nationally? Half of all homes listed have gone extra stale, unsold for 60 days on the market. After 60 days on the market. Just going to kind of cruise through these really quick. Homes are lingering on the market longer than they have in 5 years, giving buyers an edge. So it's a good time to be a buyer. Also, if you are trying to sell your property, you can always look at it as a gain. And, where would you rather, again, if you need the money, you need the money. But if you want to gain equity when these rates do drop, especially, which eventually they will, would you rather gain it in the house you're in now? Maybe yes, if you really need that equity to move. But we know most home buyers across the country, about half of them, we're going to see right here, 40% of them actually owner-occupied homes in the country are mortgage free. And existing homeowners have roughly $267,000 in equity, giving homeowners, that cushion if there's any declines in certain areas. And so, in other words, would you rather gain the equity in the home you're in now or the home you're going to move in? Because eventually, obviously, your prices are going to go up. Home prices have gone up, except for like 1 year in the 90s. And the crash, they've gone up every year since. So we've shown that chart before. I don't have it right now to pull it up, but equity gains happen all the time. When those rates drop, as they drop, we should see increased demand because there are people right now that would buy if they could. They just don't qualify at all. There's a lot of people right now are waiting for the election, which we're going to talk about. A lot of people are waiting for rates to drop and all that. We're going to talk more about the reasoning there and what's going on. But the 10-year treasury right now shot back up this week because of that jobs report that we were talking about. Well, when that gets revised, and it will be revised, and a lot of people, going to be like, well, I think this and that. Well, when you dig into the numbers, it is much weaker than was originally portrayed. So some people are saying it's political. I don't know, whatever. But that is going, we do have an election, of course. But that, 10-year treasury tracks with the mortgage rates. Also, as the splits get better, which they have been getting better over time overall, meaning the splits between a 10-year treasury and mortgage rates, we're seeing, we'll see rates drop more there. They got a little ways to go because between the 10-year treasury where that is and where, mortgage rates are, that should be about 175 point difference to 200 point difference, typically on average historically. Okay. So right now, the average mortgage rate right now, let's see, on a 30-year fixed is running at 6.8. So, if our 10-year treasury is 4.1, almost 4.2, let's just say round numbers, 6.8, 4.2. It's a little higher than it should be on the splits, but overall we've been getting better. I mean, that was much higher over the last couple of years. So we've been tracking that and talking about that as we go along here. So, homeowners are in a good spot. A lot of people are like, hey, I don't need to move. I don't have to move. I'll sit this one out maybe. Totally get that. But again, you're going to be, kind of in the same boat as everybody else, right? As we hit those different levels and we go along. So let me see here. If I want to pull this, I wanted to pull something out for you guys here. Oh no, I don't want that. Sorry about that. Okay, where is? Okay, here we go. A lot of people want to know about, should I buying now, is it worth it? Experts forecast home prices will climb over the next 5 years. Here's kind of some just mediocre, bottom line, very low estimates in price gains and equity gains. Now, typically across the country, you're going to see anywhere from right around 2.5% to 3%. For the Phoenix area, we're usually more closer to that 4.5% to 5% mark. That's why traditionally a lot of people like to come here in order to do, their investing in properties. A lot of times, along with the warmer weather and stuff. Another thing here is buying, now worth it. You know, um, you can't get away from the old supply and demand thing. So, should I hold out for even lower rates? You could wait for rates to keep coming down, but a lot of other people will too. Okay, waiting means you'll have to compete, I've mentioned this a million times, with other buyers to find the next home and higher prices, right? You're going to be competing again and those sorts of things. So a further drop in mortgage rates could bring a surge in demand that makes it tougher to actually buy a house. Okay, that's from Greg McBride, Chief Financial Analyst with Bankrate. You certainly don't have to be, a rocket scientist to figure that out, right? Rates drop, becomes more affordable. For about every 100 basis points or 1% drop, you've got about 5 million more people that could potentially jump into the market. We're seeing, when rates were lower over the last few weeks, and then they, just jumped this week. We saw under contracts and loan applications going up. Okay, it wasn't like going up through the roof, but there was a surge, and so what the key is going to be for all this, for builders, for buyers, all that sort of thing is, they're already behind the eight ball in the building, so they're going to want to see lower rates for a sustained period of time. And really it's to the point where, you kind of have to get ahead of that, and they're not, meaning the Fed, and the bond market will always be ahead of the Fed and all that. But they're very restrictive in their policy. They've got that COVID-19 era policy still. So, that's why we need some more, I think, younger people involved that can see these data points and, kind of take the brakes off a little bit more, but and not be slow to the game. But that builder sentiment, that buyer sentiment, we need to have lower rates. I mean, if you had, let's say, between 6 and 5.5, or 5.25 to 6% rates, even that for, 12, 18 months, 24 months, you're going to see, a sustained, growth period where, we're even going to have, competitive situations, because really those are kind of the average historical rates, right? Now, with a little bit better, data coming from the government as far as the labor sector, as far as keeping the rates at bay. I think eventually, over the next couple of years, we'll see rates, between 4 and 5. Now, always keep in mind with a mortgage broker, you're always going to have lower rates. Usually we've seen 25, 50, even up to 100 basis point difference between some lenders. But, are we going to see 2 and 3% rates again? Well, it took shutting down the entire, economy to get to those rates. So probably not unless that happens again. So would I wait for that? Probably not if I really wanted to move on. You know, somebody waiting another month or two to see what happens with the election, I guess you could do that. But prices always, go up typically after elections. Here are 7 of the 8 where they've gone up after these elections. here. There's also, we get this question a lot. There's also a lot of down payment assistance programs out there to take advantage of. Many first-time home buyers do qualify for that. You're getting all that money up front, so you're going to pay more in fees, more in a higher rate, but you can get that down payment. You just can't afford to save up. But the people that actually qualify, it could be up to 80% of these first time home buyers, but the actual usage is about 13%. And again, a lot of that could be because of cost and stuff like that. But just to know that that is out there, right? Just to know that that is out there. So back to my charts. So these are right now the average jump back up from right around 6 up to 6.8. Again, after those jobs reports were revised, we're going to see that plummet. Okay. Again, should happen in the next month or two, maybe 3 at the most, once they get their act together and do what they should do, and get that all going. Now, for the greater Phoenix area, we use this Cromford Market Index. And again, I've seen applications go up. We've seen people even refining. We've seen people, under contracts go up. We've seen properties being listed across the country and here locally in the greater Phoenix area going up, not greatly, but going up a little bit. And, we're hovering right around that 18,000 mark for active inventory at any given time. But the Cromford Market Index between 90 and 110 is a balanced market, 100 being completely balanced. When demand and supply are exactly the same number, you are in complete balance. If you're below 90, you're in a buyer's market. If you're at 110 or higher, or over 110, you are in a seller's market. Okay. So this is putting us right now in a balanced market, going more towards a buyer advantage right now. So whether you're a first-time buyer, don't own a home, or homeowner who might want to move on or whatever, you could look at this any which way, depending on your situation. We could certainly dig into that and figure out where you're at on this scale. And every neighborhood, zip code area is going to be a little different, obviously, which we always like to kind of throw out there for you. We'll tell you that in a sec. But this demand right now, what this means is basically when it's at 76, is 24 points lower than it should be because we're not at 100, and supply is down below, also at 18 points lower than it should be. So we right now, for all intents and purposes, we're in a balanced market heading towards buyer's market. Okay, right now. So again, it's all about the affordability factor, time of year. A lot of this is seasonal. Okay, a lot of this is also seasonal. Now, one thing I do, people ask, should I put my home on the market or not? There's serious buyers out there this time of year, especially around the holidays. There are people looking, and the retirement communities is definitely the high time of the year. So, would I put my home on the market? Sure. If I wanted to sell it, if I needed to sell it, get it done. We could certainly talk to you about that and how we could do that for you. But this is where we're at now on this. Now, as far as the cities proper, Fountain Hills, Scottsdale, Chandler, and Glendale, Paradise Valley, Mesa, Avondale, and Phoenix are technically in sellers markets. Phoenix coming in at 111, which is barely over that 110 mark for a seller's market, and Fountain Hills at 188. So nothing earth shattering there. I mean, when we were in the height of the market the last, about two years ago or 3 years ago, those numbers were up around 500, close to 500. So just to kind of give you an idea on the difference in market. The Gilbert area, Gilbert, Cave Creek, and Tempe, Peoria, those are all in a completely balanced market. Okay, so you go either way there on who has the advantage. And then for our home buyers, we have Surprise, Goodyear, Queen Creek, Maricopa City, and Buckeye. Buckeye is at 64. That is a super buyer's market right now. So guys, that's all I have for you right now. I'm going to be doing another one of these later in the week. I'm also going to be putting out some other information. There is a lot of stuff happening right now. One thing to be aware of is, I know I've mentioned this before, starting in January 2025. They're having a new AC system come out, AC chemicals that are being used. Yeah, just like they did a few years back. They're doing it again. It's part of that whole green deal thing, environmental stuff. There is going to be, has been some changes in home warranties. Just kind of think of it as when you got to change your cable bill over and over to get the best deal. That's kind of where you're at on that as far as renewals and getting a new program. We always say, get a fix or replace. You want to make sure that you're not just getting a partial replace. In other words, some of them may only cover 2 grand, 5 grand. Some of them will cover the whole replacement of an appliance or AC unit. So I will do a separate video on that. So guys, I'm going to jump and we will talk to you next time. Thanks.